The UK housing market has just taken a shocking turn, and it could affect every homeowner, buyer, and investor in the country. Property prices are shifting, interest rates are rising, and new rules are changing the game overnight. If you thought the market was stable, think again. This is what you need to know before it's too late. Welcome to UK Property Authority, the channel where UK real estate meets real news. Every week, we expose the market's biggest shifts from housing prices to mortgage shocks, so you can make smarter moves. Let's get straight into today's update. For years, the UK housing market was characterized by steady growth. Major cities like London, Manchester, and Birmingham saw property prices rise year after year, fueled by strong demand, low interest rates, and limited housing supply. However, recent reports indicate that this trend may be slowing, and in some areas, reversing entirely. The average UK property price has experienced fluctuations that many analysts describe as unprecedented in recent decades. Certain regions are witnessing sudden drops, while others remain resilient, creating a patchwork of market performance that can be confusing for potential buyers and sellers. One of the major drivers of this shock is the shift in interest rates. After years of historically low rates designed to stimulate the economy, the Bank of England has adjusted its policy in response to inflationary pressures. Rising interest rates increase mortgage costs, directly affecting affordability for first-time buyers and current homeowners looking to remortgage. Even a seemingly small increase in rates can translate into hundreds of pounds in additional monthly payments, reducing disposable income and cooling demand. This is especially significant in areas with previously high property valuations, where monthly mortgage repayments now represent a larger proportion of household budgets. Another factor contributing to the market shock is government policy. Over the past year, a series of regulatory changes and housing initiatives have reshaped the landscape. Measures intended to support homebuyers, such as stamp duty adjustments or shared ownership schemes, have had mixed results. While some policies have temporarily stimulated demand in specific sectors, others have inadvertently slowed activity. For example, stricter lending criteria imposed by banks, designed to prevent excessive household debt, have reduced the number of buyers qualifying for mortgages, particularly among younger and first-time buyers. The result is a market where demand is uneven and price growth is inconsistent across different regions. Regional disparities have become more pronounced. London, once the epicenter of property price growth, is showing signs of stagnation in certain boroughs, while commuter towns and regional cities are experiencing more activity. Factors such as work-from-home trends, lifestyle changes, and shifting investment priorities are influencing where people want to live. Areas previously overlooked for affordability reasons are suddenly attracting buyers seeking larger homes, green spaces, or better quality of life outside the major metropolitan centers. This redistribution of demand has created opportunities for some regions, while intensifying challenges in others. Supply constraints continue to play a critical role. Despite ongoing construction, the UK still faces a chronic shortage of housing stock relative to population growth. New builds are often concentrated in specific areas or price segments, leaving gaps in affordability and limiting options for first-time buyers. This imbalance means that even if demand cools slightly in high-priced markets, scarcity continues to support property values elsewhere, leading to a complex and uneven market landscape. Investors and landlords are also reacting to the shock in different ways. Buy-to-let investors, who were once a dominant force in the UK housing market, are adjusting strategies in response to changing rental yields, tax policies, and borrowing costs. Some are liquidating properties in regions with declining prices, while others are shifting focus to emerging markets or purpose-built rental sectors that promise steadier returns. For renters, this means potential fluctuations in rental costs, availability, and property standards, which can affect household budgets and lifestyle choices. Economic uncertainty compounds the situation. Global events, energy price volatility, and concerns about economic growth have all influenced sentiment in the housing market. When people feel uncertain about the future, major investments like buying a home are often delayed, which can reduce transaction volumes and affect prices. Conversely, periods of perceived stability or favorable government incentives can temporarily boost demand, creating short-term spikes that may not be sustainable in the long term. The shock is also evident in housing affordability metrics. In many regions, median house prices are now several times higher than median household incomes, making it increasingly difficult for first-time buyers to enter the market. Rising interest rates and inflation have further squeezed budgets, forcing prospective buyers to reconsider the size, location, or timing of their property purchases. For many, the dream of homeownership now requires more planning, higher savings, and potentially a longer timeline than in previous years. Commercial property is not immune to these changes either. Retail, office, and industrial sectors have all felt the impact of evolving economic conditions, remote work trends, and changes in consumer behavior. Office space demand has decreased in some urban centers due to hybrid work models, while logistics and warehousing have become more attractive as e-commerce continues to grow. This shift in commercial property demand feeds back into the broader economy, influencing employment patterns, local development, and investment strategies. Experts suggest that the current market shock may have lasting implications. Long-term buyers could benefit if prices stabilize or correct modestly, creating opportunities in previously unaffordable areas. Conversely, speculative investors who rely on rapid price appreciation may face challenges in realizing expected returns. For policymakers, the market as uneven performance highlights the need for targeted interventions that address both supply shortages and affordability issues, particularly for vulnerable demographics. Technological innovation is also beginning to influence the housing market. Online platforms for buying, selling, and renting properties have made market information more transparent, allowing buyers and sellers to react more quickly to price changes and trends. Data analytics, virtual viewings, and AI-driven pricing tools are helping stakeholders make more informed decisions, potentially reducing inefficiencies and supporting better market outcomes over time. The psychological impact of market shocks should not be underestimated. Housing is not just an investment. It is also a home, a source of security, and a key element of personal wealth. Sudden price shifts, news of policy changes, or reports of declining markets can influence buyer confidence, affect consumer spending, and even impact political sentiment. Understanding the broader context and recognizing patterns in property cycles is essential for anyone looking to navigate the market successfully. For first-time buyers, the key takeaway is to be informed and patient. Interest rates, lending rules, and regional trends can dramatically influence affordability, so careful planning and research are critical. For existing homeowners, understanding how these shocks affect property values, refinancing options, and local demand can help make better financial decisions. Investors, meanwhile, need to remain agile, diversifying portfolios and closely monitoring market signals to mitigate risks while capitalizing on emerging opportunities. In conclusion, the UK housing market shock of 2025 is not just a headline, it's a complex event shaped by multiple factors, including interest rates, government policies, supply constraints, economic uncertainty, and shifting buyer behavior. While some areas and sectors may experience temporary declines, others continue to show resilience, creating a multifaceted market landscape that requires careful attention from buyers, sellers, and investors alike. Understanding these dynamics is essential for making informed decisions. Whether you are entering the market for the first time, investing in property, or simply trying to gauge the health of the UK economy. Thanks for watching UK Property Authority. If the video helped you, hit like and comment your thoughts below. Don't forget to subscribe and turn on notifications so you never miss a major UK property update. See you in the next one. your authority on the UK real estate market.